good day traders, Chris Weston here, Head of Research at Pepperstone. So we've just seen the May FOMC meeting coming out and there has been a few surprises. I say that because the market has reacted reasonably aggressively, and certainly if we look in the interest rate markets, you can see for the December meeting we've seen about 4 basis points of cuts being priced out of the markets. You go further out the curve and you can see for June to December 2020 about 5 or 6 basis points coming out. You can see in the fixed income market around the belly of the curve, 5-year government bonds have traded from around 221 up to 229, so an 8 basis point move up is reasonably material. And certainly the dollar has reacted quite positively to that. We saw the dollar index up about 0.5%, dollar yen moving up 60 pips or so. And the S&P futures clearly not liking that move up in rates, and the S&P futures came off about 1.3%. So it still is my base case that if we are going to see the S&P and global equity markets under sizable pressure, then real rates need to move higher and interest rate markets need to reprice quite aggressively. There's obviously no reason to believe that's going to happen too substantially. But what we saw from this meeting has been one where the market had gone into this meeting expecting a much more dovish shift from Jerome Powell, and that necessarily hasn't happened. In fact, one would say this is a hawkish hold, and you can see that from the market pricing. One of the things we have looked at is, I think, the reaction to the comments that the weakness we've been recently seeing in core PCE at 1.55%, and only 5 basis points or so away from Charles Evans's categoric level of 1.5% on a sustained basis, is the idea that some or all of these measures were transitory. He's prepared or feels quite comfortable with an inflation undershoot. The fact is that he genuinely believes that we are going to see core inflation moving back up towards the Fed's target going forward. So the fact he is comfortable with this inflation undershoot is something the market wasn't necessarily prepared for. And if you are positioned or you're long rates or long fixed income and the idea that we're going to see nearer term rate cuts coming through, well, you just haven't seen any substance to that to warrant this position. So when you're marking the situation, you've seen a few people looking to close out. That said, the other rhetoric as well is quite on the sort of more hawkish relative to expectations situation. If you have a look at when he was pressed around insurance cuts or maintenance cuts, as people have come to talk about it these days, he sort of quickly moved on. So there was no real exploration around what some other members in the Fed have been talking about, this idea of cutting the Fed funds rate just to sort of maintain what's been going on and try and steepen the yield curve a little bit, similar to the exercise that we saw in 1995 and 1998, which is a case study that a lot of people on the Fed have been talking about recently. But certainly the fact is that Jerome Powell moved away from talking about maintenance cuts or insurance cuts is something that resonated with markets as well. The other issue is that he focused on financial conditions and talked out the fact that they had eased a little bit and become somewhat more favourable in Europe and China and certainly in the US as well. And he wasn't too concerned about what we saw from that weakness in the ISM manufacturing number that came out earlier in this session, multi-month lows as well. So, again, you've got this idea that the Fed president has distanced himself from the comments we've seen from the likes of Richard Clarida, Charles Evans, Robert Kaplan, and he is his own man in that situation and is prepared and fairly comfortable with an inflation undershoot. It just doesn't justify this dovish position that's priced into market. That said, if inflation doesn't start gravitating higher going forward, I think the bar is sufficiently low for the Fed to cut. I certainly don't sit in the camp that they're going to be looking to hike anytime soon, and I think the bar is still very low. So if we are going to see financial conditions tighten, if the dollar starts moving up more aggressively and threatens their inflation expectations, the Federal Reserve could cut rates at some stage later this year, and that's not discounted into markets, and I think that's something that we do need to consider. So I think the dollar is very, very key, and I think that the Fed chair there will change his opinion and align himself more with Richard Clarida and other Fed members if we see financial conditions tightening. If we see inflation expectations moving lower, I think that would change his tune. So I think the bar is still sufficiently low. He just believes at this current juncture that the Fed is positioned dovishly enough not to warrant that and keep the expansion going forward. That said, I think what we now need to look at is continue to look at the dollar, continue to look at inflation expectations. This Friday, we're going to be watched very closely to see what other members from the Federal Reserve continue to make of this situation. We've got John Williams, the New York Fed president, talking on Friday. We've got Richard Clarida again talking, and again, will he back up his comments? You've got people like Jamie Bullard speaking as well. And this comes at a time when we've got non-farm payrolls numbers, we've got the ISM service numbers as well. So I think what we're seeing, if we take a holistic view here, is that Jerome Powell has distanced himself from other Fed members. The market was positioned for quite explicit commentary that didn't come, and I think we've just seen a little bit of repricing. That said, I think the bar is sufficiently lower. The other thing that we're talking about is the idea that the Federal Reserve have lowered the interest that banks can park their reserves with, the excess reserves with the Federal Reserve. They were earning 2.4%, and the Fed were using this as the top end of the range to guide the Fed funds effective rate, or the cost for interbank liquidity, interbank borrowing, and they've lowered that to 2.35%. So I wouldn't read too much into that situation. More this is a technicality around how the Fed guide the Fed funds effective rate. It's not necessarily a hugely dovish situation, but what we want to see now is the level of reserves in the system. They potentially could go a little bit higher because banks are disincentivized to hold so much reserves with the Fed. That could have an impact on repo rates and US Treasury, very short-term treasuries, and that should really, idealistically, a situation see the Fed funds effective rate moving a little bit lower and reserves in the system increasing. Could be a small US dollar negative in that sense. So one to watch there, but certainly more on the technicality front there. But certainly we are watching this, and I think again we're just seeing a situation where this Fed meeting was probably a little bit less dovish than what the market was positioned for given recent rhetoric.